Hello, YouTube. We are at a turning point for a big move, either 35 points higher on the NASDAQ or 45 points lower. We now have two weekly candle closes over the 50 MA, but we did close red. So both the bulls and the bears are going to have some fuel in the tank this week for their story. And as we look here, it is really important to understand that it is okay to be wrong, not okay to stay wrong, because as we go into double-digit losses, it gets a lot harder to make back your gains. Every time we go lower, you got to make back more to get back to zero. So if you're on the wrong side of the trade and we are headed to 330s, very important to know where you're wrong. But if we're also going to dip back down and you're bullish, very important to also know where you're wrong. We're going to provide both an update to the bull scenario, which we laid out in late December, and the bear scenario I laid out in early January. Let's do that really fast now. We're going to focus on the NASDAQ. A lot of the same applies to the S&P, which we will circle back on and talk about at the end of the video. So with two closes over the 50, but closing near the low of the week and red, it means that if this is it and the back test is over after birthing a new bull market by getting a weekly candle close over 305, we shouldn't look back from here. We should slingshot off of the 50 MA and start making progress towards 330s. If on the flip side, by closing near the low of the week, we bear pivot off this area and we form a weekly lower low, well, that's the start of a downtrend. To be two lower highs and one lower low. That could either be a flag or a bear trend starting. It's that simple. Looking here to the monthly chart, the numbers are already here. So let's look at the risk reward. It is $1. Sorry, if we fall below $3.99, that is the most important number to start with. Why? Because we have a breakout, but if it fails to hold, it's not a breakout anymore. It is now a failed breakout. So if we have a failed breakout and we fall back below 298, that is where we could come all the way back down to support, which is 38 points lower on the monthly and only 14 points higher back up to our February high. So if we start shooting lower, we have to be very, very mindful of that. So if we start going red, yeah, that's like really important. We could push down 38 points. And the bears right now, if we fall back below 299, they have a skewed risk reward. They can make $2 when the bulls could only make one. We have to get above the February high to make it to our other relative high at about 330. So remember that. It's really important. We're now going to go through a little bit of a story, and then we'll circle back and give you an update on S&P, which you can see the numbers on here, QQQ. We'll talk about DXY. We'll talk about the VIX. We'll talk about the 2-year note, which has a bullish monthly engulfing candle, flashing a mega warning that we could be going down. Remember, the bond market usually means that when we go up, stocks go down. That's a powerful move, 7.5%. So let's go through and see what happened here. Larry Summers, who I believe Jerome is taking a lot of his playbook from, he gives us two nice headlines here on Friday's Wall Street Week. The Fed understands that it doesn't understand. So if you're pretending you know more than Larry Summers, former Treasury Secretary, more than Jerome Powell, you might be a little bit naive. And consensus has become too complacent on inflation, which could lead to what? Turbulent times. All right, why? Comes down to this number here. The bulls are going to say that CPI on a headline number is coming down. But yes, the Fed does not actually track that. They track core PCE, not headline CPI. But anyways, instead of trying to tell the market what it's going to do, let's understand what the stakes are. Like it's a Super Bowl. If the bulls are going to go for the touchdown, it means we got to smash this number lower. And right now, it went from 8 to 7 to 6. We're not quite into 5, but a surprise could bring it down to 5. I think that's not very likely. Why? I'll touch on that in a moment here, but this is really what the bulls are leaning into. So for a bull pivot, this needs to accelerate. I'll show you here on a couple of tabs later the reason why I think the bears are going to focus on a different number. So if we understand that right now, what is driving the market is greed, and the greed is currently high, higher high, higher high, higher high. So if we remain over the elevated level of greed at roughly 65 and 60, we're back testing the level of greed, which in my opinion means that we're actually back testing where people are currently trading. We showed you this chart. We're now here at performance chasers. So people are getting greedy, like buying Tesla over 200. Yeah, that's chasing performance. So if people want to keep chasing performance, maybe we keep going up. But on the flip side, US financial conditions are easing. That's like not so good. No, it's not so good. And what happened? Well, let's look to the data that's going to be coming out next week, because I think it's really important to focus on what could happen on Tuesday. I just alluded to it briefly before. So if we look here, what the bulls are going to focus on is going to be that headline CPI, which again, the Fed doesn't track, went from 6.5 to 6.2. So the number they're going to focus on is that, well, inflation's coming down. Yes, that's correct. But the problem is that Going from 7.1 to 6.5 is a reduction of 0.6. To go from 6.5 to 6.2 is 0.3. That's why Larry Summers just said that I think people might be a little bit too complacent on inflation. Why? Well, because it's not coming down as fast as it used to. And we also have BlackRock and PIMCO confirming that. They push back against Bet's inflation is cooling fast. It's still cooling. It's just not cooling fast. So if we pick up where the story left off here and we just keep going, we recognize that the bulls are just going to say, yeah, well, it keeps coming down. Okay. Again, Jerome's a little less confident than the market. Larry Summers kind of confirms it. The bears are going to point to this, where we had 2 months where inflation came to 0.1 or negative 0.1, but now it's set to reaccelerate to 0.4. And why does that matter? It matters because it means the line's going to come down on the yearly, but slower. And the Fed does not even track this number. The Fed tracks PCE. They don't care about CPI. So make sure you understand what you're tracking. And then there's the technical reasons why we want to be mindful of them. On Tuesday, we have core CPI, and we just told you, like, we're hovering near the low of the week. If we form a lower low on the weekly, that's 2 lower highs, 1 lower low. And then on Thursday, we also have initial jobless claims, PMI, and PPI, which are going to be going from negative to less negative or negative to positive. That stuff really matters. Looking here to another economy, which is similar to America, but not the same, Canada. If we look in here nice and close, if we go back to November, we saw 10x on jobs added in December, 10x on jobs added in February. That came out on this last week, 10x. So maybe all those gains that we saw in America, meaning 500,000 jobs added, is not so weird. And bankers are thinking about it's challenging basic theory of economics. Are the models working? Do we really need to increase unemployment to bring down inflation? I think that's really important to understand right now. This is what the bankers are thinking. It's why they paused. Must make them at least a tad nervous. I think so. Jumping down to the next headline, no easy way to restore price stability. Oh, that sounds like a tough job. A weird time for the economy. Yes, everyone's agreeing. And why? Well, if this was the recession in Q1 and Q2, we're probably going to expand. We're going to see things like higher job numbers, higher retail sales, higher inflation. Yes, that's what happens. We're expanding. The economy is expanding. And that's the challenge right now. So if good data is good, we're going to find that out this week. We should just be moving higher. If bad data is good or good data is good, we should be moving higher. But if bad data is bad or good data is bad, we're also going to find out. So if the market is currently shrugging off and expanding because we're avoiding recession, it shouldn't matter what comes out for CPI. We should just rally. And on the flip side, we should fade. So now let's go through some charts to try to give you an actionable plan for this week, because we're going to look at only the things that really matter: S&P, QQQ, the dollar, VIX, and then treasuries. And we'll leave the rest for you for those weekday updates. So please make sure to subscribe if you're enjoying the content. And I would really appreciate a comment. Tell me what you think so far. I'm putting in extra effort to make the story easy to follow. So the turning point, yes. So now technically, tell me what's happening here on the chart, Justin. So we look here to that monthly area at 299. It means, yes, if we hold the low and we advance, that's bullish. If we form an inside bar and then break bullish. If we have another inside bar, it means we're getting indigestion. We had a big meal, like a Super Bowl Sunday meal, and then we're like, oh man, I need to rest for a bit here. I gotta open up my belt. I'm getting a little bit fat. I got a belly, but then we start going higher. We get hungry again. On the flip side, if these bears are going to come, all they got to do is just knock it down below 297, or like only about 1%. It's not really that much more. They already got momentum by closing down by 2% on the week. And then that monthly shows that, oh my goodness, it's now, I could potentially make $2.7 for every $1 I'm betting short. That's where the bears are going to look to start getting right aggressive. And for bulls like me, I'm like, well, I'd rather see the bulls. I don't want to be the one to move this thing higher. I want someone else to move it, and then I'll piggyback on the trade. That's the best way to explain it. Looking to S&P now, very similar story. So even though the NASDAQ birthed a new bull market last Friday, the S&P's been struggling at 414.05 and 417.8. Why? This is where S&P births a new bull market. If it can close a weekly above that, I would say we're in bull market territory. And 414 is 50% Fibonacci retracement from our all-time high to our October low. So we recouped half the losses. That's a natural area for robots to take profit. We now also have 3 weekly candle closes over our 50 MA. We have bounced off our 2018, 2020 all-time high. And that's what I would expect if we were going into the recession back in here, which was confirmed. We bounced off the recession and we're going to go higher. The Fed is the question. I'm not sure. So it's really just about whether we're going to hold the 50 MA here, which is at about 401. Why does that matter though? Well, because the monthly chart, which is not going to be closed out for about another 2-3 weeks here, is telling us that we're already seeing some warning signs. If we fail to hold 409, it means we actually have a monthly failed breakout that's forming, not formed, right? Remember that we're talking about something that is happening versus happened. So if we fall back below 408 and we go red in the week, it means the monthly chart is flashing a warning. We bounced off a micro higher low, went to a higher high, we broke out, we failed to hold it. So what could happen? We could come all the way back down by 30 points to retest that monthly low. That's strong support. That's where buyers should show up. But if we're over 409, there's an easy area to set a stop, which is going to be the low of the month, currently at 402, 4023, which is what? Roughly our 50 MA. Oops. Let me go here to here. That's roughly our 50 MA, 401. So if we're over 400 but over 409, the rally gets a little bit less friction. It can go back to its relative high. That's what S&P is really looking at here. It's super simple. Rewind and replay if it's not clear to you. I think it did a great job explaining it. And please drop me a comment if you agree or disagree. I'm a big boy. I can take it if you don't like my commentary. Looking here to the DXY, looking at the monthly chart, what's really important is that we're trending up and we're over a key pivot. What was resistance in 2016 and 2020 is becoming support in 2022. So it looks like it wants to what? Keep advancing. Get back inside the pocket. Maybe make progress towards 120. Looking here on the weekly, we're also trending up for a 2020 low. Bounce, bounce, bounce. We got higher highs forming, bullish engulfing last week. We got continuation this week. That looks like pretty strong to me. So it looks like it wants to keep chugging, and we have to be mindful of it. Looking here to the VIX, the VIX is forming one of two patterns. I'm not sure which one it's actually going to do. So it really depends on what the market does, because if the market goes down, VIX is going to explode and form a massive monthly W. If on the flip side, the market is calm, cool, collected, Jerome's going to get the soft landing, head and shoulders, knees and toes, we should go back down to low teens. I'm talking like 15. On the weekly, we're just really we're stuck in a range here. Some bouts of volatility, but not a breakout. And every time we get to the high teens, 18, 19, we always bounce. Looking here to the 2-year note, Golden Cross, massive weekly move, massive. Looking here on the monthly, bullish engulfing candle. That is not good. Bond market votes, it's also bigger than the stock market. And if it goes up, stocks usually go down. And then finally, we got the 10-year note, only up by 6.5 here on the month. It's got some lower wicks. It's bouncing off its relative high. And that is it. Please tune in for the rest of the week if you want to get updates on this. If not, thank you so much for watching. I look forward to seeing you on the next one.